Well, hello and welcome to Trading Blows. Plenty to discuss in the show this week, including last week's plethora of central bank decisions, what they mean for the respective currencies and economies, and how the policy outlooks have evolved across G10 monetary policy. We'll also examine whether the idea of US exceptionalism may be starting to come under just a little bit of threat, and we'll also discuss where the risks lie for both equities and bonds as the end of the year looms, with around 6 weeks of 2023 left to go. Without further ado, let's get into the show. So, as always, a lot for us to discuss on the show this week. Joining me on the panel, we have Richard Matthews, the head of FX and partnerships over at One.io. Also, Ryan Paisey, the founder of PiQ Suite. And last, but by no means least, Adam Linton, head of the European desk over at Newsquawk. As always, the panelists will be going head to head, scoring points for a great answer and having the threat of points being chalked off looming over them if any disputes are raised over what they have to say. With that said and done, let's get into the first round. So it was a busy week last week of central bank decisions. We had the Bank of Japan, the FOMC, the BOE, and if anyone cares about it, the Norges Bank in the mix as well. Mr. Linton, let's start the show with you. What are your sort of main takeaways from that plethora of policy announcements that we had over the last 4 or 5 days?
We get that you know the word plethora. That's twice you've used it in like 30 seconds.
What does it mean?
I don't know, but I don't really know either. He's got to be on -1 point if he uses it again. Sorry, Adam, go ahead.
He's half for Spurs next week.
In terms of like the big three that you mentioned, you know, the BOJ, Fed, BOE, I think, you know, the main takeaway was, at least for the Feds and the BOE, and then to a certain extent, BOJ, depends on how you frame it, it's more of a dovish takeaway. I think, you know, if you start with the BOJ, I think the main story is, you know, I think you kind of framed it as yield curve control dead, you know, when you kind of send the email over. And ultimately, you know, it's not necessarily dead yet. They haven't formally scrapped it, but ultimately they are paving the way for it to be kind of removed later in the year or towards the end of or the start of next year. I think the main thing really to bear in mind, though, is, you know, what is the aim here for the BOJ? We saw them increase the flexibility last week, but what is the aim? Is this paving the way for an end to negative interest rate policy? Or is this just to make policy, you know, easy monetary policy more sustainable? Or is it simply to defend the Japanese yen? I think these are some of the questions you need to be thinking of in the coming months when it comes to the BOJ, because that'll be ultimately what determines, you know, when do they get rid of yield curve control. I think a lot of desks think that'll be kind of be January next year when they have their next outlook report. And that'll be kind of interesting to see if they follow through with that, because then the next step after that will be ending of negative interest rates. And, you know, I've been quite consistent for a few months now that I kind of think that ultimately, if the BOJ is to hike in, say, April, that would make them the hawkish outlier within G10FX, you know, because the rest of the world will be either kind of pausing on rates or they'll be kind of thinking of cutting rates. And again, I think that's quite a hard thing to imagine. You know, my career, having followed the BOJ, them being the hawkish outliers does seem a little hard to believe. And then, you know, in terms of the other two central banks, I think the Fed is quite a frustrating comms exercise for the Fed at the moment. I think ultimately they are done. The economy is beginning to roll over, which we'll touch on later. But, you know, because ultimately policy is going to get incrementally tighter regardless of whether they hike or keep rates unchanged. You know, as inflation falls, real yields rise. They've got QT running in the background, and they've got the impact of other rate hikes to kind of follow through. So we're kind of stuck in this dance at the moment where the market thinks they're done. I think the Fed thinks they're done, but ultimately they can't say they're done because they want to manage inflation expectations. So everyone's kind of, you know, doing this, acting out this kind of, you know, falseness of, yes, they could hike. The Fed says they could hike, but we all know that they won't. And that's why you're not seeing any of the hawkish comments you've seen this week really have too much bearing on market pricing. I think the real thing, if you're going to watch anything with the Fed, is the move we've seen in yields, which we'll touch on later. If yields do begin to pull back, then what does that mean for financial conditions? The financial conditions ease the point where the Fed perversely actually then has to hike in December or January. That, if there's to be a big thing to happen with the Fed, I'm pretty sure that'll be the area of interest that people kind of need to follow. And then Bank of England, snooze fest. We knew it would be. They paused in September. The monetary policy report, yes, growth seen at 0% next year. But last November, the monetary policy report said 5 consecutive, was it quarters of recession? And that never happened. We saw the comments from Pill early this week saying they could cut beginning in middle of next year. But I think that's kind of out of consensus. I think, the messaging is premature to talk about cuts. So they're on autopilot.
Yeah, it did feel like Hugh Pill went a little bit off his sort of approved script with that one. I don't think the governor would be.
He's known for being a bit on that kind of persuasion anyway, isn't he? So
yes, definitely. Go on, Ryan. Take it away. What are your thoughts on all of this central nonsense?
Well, as always, Adam speaks for all of us. So I think the more Adam talks, I think we should all get some points as well.
I second everything Adam said. So can we just score the same points again?
Exactly. I think he's exactly right about the Fed recently. It's been a ridiculous week. Couple of weeks in terms of central bank speakers. It's an amazing talent to say loads without saying fuck all.
Are you talking about me or the Fed?
Well, a bit of both, to be honest. As an avid listener to Newsquawk, I can hand on heart say bit of both. I jest Newsquawk, best squawk out there. Thank you very much. And today was quite an interesting one. Obviously, today being Wednesday, it goes out tomorrow. So we've had a plethora of ECB speakers.
Oh, bravo! Bonus point.
Mate, I'm impressed that I managed to say that. So we've obviously had a plethora of ECB speakers today, and they're obviously all told what to say. It's very much inflation's come down, but we are not done yet, or at least we're not thinking about cutting. Cutting is not on the ECB radar. Combination of why they've probably come out and said that is because obviously inflation data is coming off the boil, which raises the question. More importantly, yesterday, and I don't think the timing isn't a coincidence that we're having this today, because yesterday we had absolute bucket loads of awful German data. Not just data, but in terms of surveys, and also we had some commentary coming out from IFO, like the chemicals industry, which is massive in Germany, is going through the ringer. So there's obviously a lot of kind of problems brewing, already brewed in Germany on that front. So the ECB, of course, they're under pressure to look to give Germany a bit of a favour by definitely not hiking. But as we've kind of found out increasingly so over the last 18 months, that Germany maybe don't have the sway that they used to have in the ECB, especially after, what was his name, quit the ECB to
Weidmann.
That's the one.
Yes.
So maybe Germany are kind of looking over their shoulder thinking, fuck, we haven't got our inside man pulling the strings in the ECB. So I do think the ECB is kind of, for the first time in eons, more interesting to watch. A bit like what Adam said, for the first time in eons, Bank of Japan are kind of now in an interesting situation. So it's definitely, things are definitely kind of moving. And for a trader that's kind of an FX trader that's looking to do these kind of trades based on, interest rate differentials and stuff, this is probably the best time to be doing that sort of trading. If that is your bag, it's not my bag, but if it is your bag, probably the best time to be doing this sort of trading since 2010. So it's, you know what I mean? Because we've been stuck at, everyone's been doing the same thing, or we've been cutting, or we've been going up, but we're in a proper there's 3 or 4 central banks out there now that you could make an argument for them to cut, pause, or hike. Maybe not cut in Bank of Japan's case, but you see what I'm saying.
I wouldn't put it past them.
On the Bank of Japan, one thing that Ueda said this morning in the early hours, so yesterday for you guys, was that the central bank wouldn't necessarily wait for the wage growth to turn positive, inflation adjusted wage growth to turn positive, before they end the ultra loose policy. This, again, it just feels like one of those comments that you make just to pave the way for removing those barriers to entry for hiking rates, or not just hiking, but just removing the ultra loose policy. Because there's do we think this though? Sorry to interrupt. Do we think this though, or is this kind of like a soft touch attempt to kind of support the yen? Because that's the one thing no, absolutely. I think
he did that head fake I can't remember when it was, but it was maybe in September and stuff. And I'm
Look,
a little bit cynical whether this is like a true policy intention, or is it like he's just trying to do something for the yen?
And also, let's be honest, like Bank of Japan, they're the kings of head faking, because all this crap about YCC and all this like intervention levels and stuff. They're the kings for kind of just putting comments out there. But the fact that they're now actively saying about the removal of ultra loose monetary policy, it's either a sign that they're taking that head fakery up a notch and they're actually talking about the ultra loose policy itself rather than things to kind of, if you think about it, that's one thing to do, whereas the other thing is just kind of trying to constrain the markets within that ultra loose policy. So beforehand, we've been talking about YCC and intervention in the FX, but nothing to do with the actual policy side of things. But now they're actually starting to talk about the policy. So like you said, rightfully say, is that just taking head fakery up a level, or are they really starting to kind of just make sure everyone's on the same path, that don't expect us to wait for this to happen before this happens?
Yeah, I think the main thing is like new traders is that the BOJ of all the central banks is by far the biggest minefield within G10.
Oh, massively.
Oh God!
But I tell you what. So if we exclude the fact that you would never ever try and second guess the Chinese government, right? Just don't do it, right?
Yes.
Apart from them, never ever try and guess what the Bank of Japan is going to do next, because you do not know what to say.
The other thing is when you have to produce a slide, which to try and simplify what the policy announcements that you've made, and the PowerPoint deck that's meant to make it simpler actually makes it more complicated. I think that kind of sums up the shambles that they're in. Dick, let's bring you.
Sorry.
Very patiently there. Go on. What are your thoughts, particularly in terms of the FX market? Ryan touched on this, in terms of trading on rate differentials. You've got the BOJ who are coming towards the end of negative rates. The RBA, of course, down in Australia on Tuesday morning, sacking off a 5-month-long pause and hiking rates once more. The Fed looked to be done. The BOE looked to be done. What does this all mean for the FX market, do you think?
First off, I do agree with Ryan and Adam basically on pretty much everything they've said, and certainly the BOJ is inscrutable. They're probably more reliable than the Chinese, because I don't think you can believe any word the Chinese say. Yeah. But the BOJ, you really have to interpret it, and I think however hard you work, they're just really, really obtuse. So I totally agree on that. I think it's interesting. We are finally poised now between, are we going to hike next, or are we going to cut next, or are we just going to stay where we are? I actually think, as always, that the next move by the Fed will be up. I wouldn't discount a hike in December, January. I think the BOE, as normal, doesn't know what the hell it's doing. I was amazed to hear what Phil came out with. Was it yesterday or the day before yesterday? I just think that he got carried away. Excuse me. Although he did say the cut before an election. When's the election? I don't think they can actually run it until 2025. Can they? March 2025?
Yeah, January 25.
Try to.
Yeah.
I don't think they will. If that's the case, you might see a cut before then. I think things are starting to slow down here, although M&S's figures were very, very good. Despite the fact that they're warning of worse ones to come. So if you're looking at interest rate differentials, I said one of the first trading days we did, I thought the ECB would be the first to cut. I still think they'll be the first to cut. I disagree slightly with what Ryan was saying about the German influence. I don't think it's because they haven't got an inside man there. I don't think they've got the industrial clout they once had. I mean, Germany
as well
is almost the lame duck of Europe now. It's going to have problems through the winter. I can't believe that Putin doesn't try and squeeze oil and gas at some point. We've already seen this with odd things going on some of the pipelines. So I think the ECB probably be the first to cut. I would never, ever want to buy sterling unless I was covering a short. And I know that Ryan always laughs at this, and he's historically right, and I'm historically wrong on that.
But not right, man.
No. So I think that on that basis, I think the Fed will have to hike again. So I'd still be a buyer of dollars and seller of euros. They're very, very reliant on the long end doing the heavy lifting for them. I mean, 2 points on that. US mortgages are very different to UK mortgages and European mortgages. They run for a very, very long time. And so people just aren't moving. So they're not hit quite so hard by the move in long-term rates. And secondly, what happens if bond yields turn down? We got this 4.5%. I know we'll come on to this a little bit later on, but we got like 4.5% seems to be support at the moment. If it starts breaking down through that, less supply than people thought maybe it will, what will the Fed do then? Oh, our heavy lifting's gone. What do we do? Do we have to hike to replace it? And everyone's, oh, it's great. The bonds are doing the heavy lifting. Well, what if all of a sudden the bonds don't do it? A very long-winded way of actually saying, I'd still like to be long in dollars and short a euro. I'd buy some sterling for historical to have something in my pocket when I go to Arsenal.
It is a good point. Sorry, I was going to say, it just comes back to that game of bluff that Adam was mentioning in terms of, if yields come lower, do the Fed become a little bit more hawkish in their rhetoric? But then actually, is there any point in them doing so? Because we all know they're probably not going to hike again anyway.
I think they will.
Just on Dicky's point about, selling euro, buying dollar, and his logic being that, euro could cut, ECB could cut, Fed could hike. When you think about it, they don't even, for that trade to be a decent trade, they don't even need to do that. Like the Fed don't need to hike for that to be a good trade. So I've just pulled up the chart now thinking, hang on, I think I might have a little nibble on that myself.
It must be everyone do the opposite now. Ryan's put the kiss of death on it.
Well, this is it.
It must be a very crowded trade if Ryan can spot it and I can spot it.
Well, I think exactly that.
So, on that basis, let's start buying the euro selling dollars.
Right. On that note, let's get on to the second round. So, Dick, actually, let's stay with you. I mean, you're Mr. Fed are going to hike again. I guess the message from the data is that they might not need to. The labour market seems to be softening pretty substantially. If you look at, payrolls on Friday below expectations, unemployment rising. And actually, I think most of the US data that we had out last week missed expectations. From memory, I think it was just the JOLTS job openings number that came in above expectations. So, are you still relatively bullish on the US economy, or do you think this idea of US exceptionalism might be starting to run its course a little bit?
Was that a plethora of data or smorgasbord data? Smorgasbord of data. Get onto the Scandis in a minute. I don't think the non-farm payroll is quite as bad as people are saying. You've got this funny auto workers union strike. I don't know how much that's affected the number that came out. They're still on lines to create 2 million jobs this year. JOLTS, I still think, as you say, was a good number. Unemployment, I think they're very, very comfortable. I've said this time and time again. I don't think they get wide until it gets to something like 4.5%. It's running, 3.9 now, I think. So I think that the Fed will be quite comfortable with the employment scene. It's creating more and more jobs, money coming into the economy. I actually think that the macro data coming out of the States isn't quite as bad as they look. So I think they're okay. I think it's the only couple of things I'm watching for, on the contrary to what I'm saying, is money supply. I know I can't about money supply constantly, but I think money supply is still dropping quite sharply. And I did see a really, really funny number, and I think Ryan may have posted it, about oil-based lubricants selling at their lowest level for 40 years. Is that correct?
If I did, I didn't think I was posting it, but yeah, it's in my kind of remit of kind of stuff to post. But yeah, I love a bit of lube.
It is in your sort of remit, talking about lubricants, which obviously I presume is sitting at heavy industry at some point. So maybe there is a slight slowing down there. But to me, an economy that creates 2 million jobs a year compared to the economies in the UK and in Europe, I think it's exceptional. I just think that just keeps on rolling and keeps on rolling, and it's almost like it's ignoring the heights that the Fed has done. It just carries on. I don't think it's slowing that much, although watch the money supply and watch credit card indebtedness.
Do you think, Dick, I'll bring the other two in a second, but I know we've spoken about this before, and maybe on one of these shows, but certainly one-to-one. This idea you've had before where inflation is likely to make a resurgence, do you think that there is still a risk of that given how strong the US economy remains?
I do, and I say there was a real risk last week, and I saw there was a trampoline on our railway line. I love talking about trampoline inflation. I thought it was already hitting Hastings. Yes, I do think there's a real risk of inflation coming back in, without a doubt. I think the amount of money that Biden's promising to spend on arms, and we'll come on to this a little bit later, on arms for Ukraine and Israel and wherever else, will feed into the economy, will spurt the economy. So I really do believe there's a real risk of inflation coming back in. And going back to what we were just talking about being reliant on the bonds to do the heavy lifting, I'm not sure they are. And I think if you suddenly see any sign of inflation coming back, they're going to jump on it like me, heavily and quickly, and they will not be scared to hike again. So, and it is, people keep going higher for longer. I actually think what Helen Thomas says, who writes Blonde Money, high for long is what we've got to get used to. These are the levels of interest rates that the economy's got to get used to having. And there's this nonsense about zero interest rates and zombie companies. That's gone. That's out the window. If we got to take some pain, we got to take some pain. So I actually think that rates are going to be high for long. And I certainly think that you're going to see a bit of inflation come back in.
But what is this high? It's not high.
No,
it's not high.
Exactly. And this is what annoys me. People say, "Oh, you've got to cut rates. You've got to cut rates." They're not high yet. If they were, 7%, maybe 7-8%, they'll say, "Okay, that's high enough. You're going to have to cut to get economies going." They aren't high. They're historically very low. They're probably below the mean of my working lifetime. Back to the Bay tapestry I saw. It was related to recently, but they are historically very low.
So we're significantly more levered as an economy, though. So the more interest rates go up, the more damage it does.
Well, people shouldn't borrow. They all drink too much and they all borrow too much money. That's my view on it.
Well, there we go. When Dick moves into 11 Downing Street, that might be the case. But until
then, God, no.
you could evict Rachel Reeves, I suppose, at some point. Right.
Yeah. Except she wouldn't see the note that I was doing it as I'm blocked by her on Twitter.
Oh God! Right, we won't go into that one.
No.
Ryan, what are your thoughts on the US economy? I mean, if you look very crudely at GDP, the US was 4.9% on an annualized basis in Q3. We're looking at a quarterly contraction of about a tenth when the data comes out on Friday, and Germany with pretty much nothing going on there. Is the US still the best of a bad bunch, given that alone?
Yeah, of course. It's simple. It doesn't get much more simple than that. You're talking about the strongest economy in the world. If the US is fucked, then everyone else is already fucked. So in that very simple
being unusually restrained there with your language.
Well, I'm trying, mate. I'm trying because I heard that Dickie got told off for swearing, and I'm new me kind of vibe.
And I was in the jail.
Well, yeah, true. But yeah, so I think what is it? I always say, like, if in doubt, you do hard to do better than just sticking your money into like an SPX tracker. But in terms of the US as a whole, all this, will they have a recession? Won't they have a recession? As I've said before, no one that really knows about markets or actually trades markets gives a crap if it's technically a recession or not. The fact is, the markets are trading well. Obviously, everything at the moment is a byproduct of 10-year yields. And when this is something that we said a couple of weeks back, it's the most important market in the world. I think I've quoted Warren Buffett. Well, I highlighted what Warren Buffett said years ago, but a couple of weeks ago. But he said, "Look, if I could know, if you could know the price of one asset in 10 years' time, what would it be?" And he always says the same answer: 10-year yields, because it's a direct. It's what you need to be benchmarking everything against in terms of what's generating value, what's not. And also it gives you an idea of where the risk is, like kind of risk appetite is. One thing that on the US economy, though, or the US macro kind of market kind of vibe, that I found quite interesting is one of the CEOs of one of the banks on Wall Street. I can't remember which one it was, but he raised a really valid point that for decades, but historically, stock markets and GDP track basically the same performance. Now, since the use of central banks coming in with QE and stuff, like stock markets have doubled and GDP's gone sideways, and that's all debt related. That's all this VC capital that's flown into like your tech bubbles and all stuff like this recently, and all these like stupid valuations for like losing firms and stuff. It's all on debt. There's trillions of debt in the market at the moment. That will come out. It's not going to come out all at once. I know some Twitter fearmongers would like to see it all come out at once. It won't do that. But you do need to have it in the back of your mind that what we're seeing at the moment is largely driven by debt at near zero rates. So that is going to be a headwind. Is it a headwind right now? Probably not, because we're still living the vida loca. But if we do have rates not higher for longer or high for longer, or just where they are now for longer, we will see those markets tighten up, and we will see that debt having to be repaid. And as that debt is being repaid, what are they going to sell to pay that debt? They're going to sell what they've bought with the debt, which all comes back to equities at the end of the day. So look, that's not me saying I'm bearish stocks, because I'm not. I'm always bullish stocks. But it's just something to bear in mind that, choosing your moments to get long, it's not a case of, as it was in, back in the day when it's zero rates, where you just buy the high because tomorrow's going to be a higher high. But going forward, we are going to see probably more chop in the markets, and we are going to see, and we're going to see bad prints in data. But then of course we come down to like, is bad data good for markets because it increases the chance of Fed cutting? I'll tell you, it's probably an extremely tough time to be looking to be a trader right now. As an investor, I think you're doing all right, but as a trader, there's a lot of moving parts at the moment.
Yes, very much so. And of course, we'll get on to equities a little bit more in a second. I do agree with that. And I think, we saw a prime example of it this week with WeWork. They've gone bankrupt for, I think, the second time now. But, they are a great example of a company that was, fueled by debt and borrowing at, 0% rates, grew far too fast for their own good, and are now facing the consequences of that. But, of course, you've got the broader slowdown in the office and commercial real estate space in the mix as well. But it's a good example of what you're saying. Adam, what are your thoughts on what's going on with the US economy? I mean, particularly, which way do you see the risks here? Do you see the risks tilted to the upside or to the downside from here on in for the States?
I think when framing the US economy at the moment, I think the conversation, barring a surprise next week with the inflation data, we've very much moved on from what's inflation doing to, what's happening with growth and what's happening with the labour market. When it comes to growth, I think there has been a bit of a divergence between the soft and the hard data, but typically hard data is a lagging indicator. The soft indicators that you pointed out, such as the ISMs, they're clearly leaning soft. I think Morgan Stanley earlier in the week said, when you look at the hard and soft data, you can kind of make a viewpoint for any kind of, analysis of the US economy you want, but I'm kind of leading more on the soft side. And then, the labour market, yes, payrolls are still historically strong, but unemployment's rising, wages look like they're rolling over. So things look like they're softening. And I think, as Ryan makes the point, you're going to see loads of rubbish about, is this going to be a soft landing or are we moving to a recession? It doesn't really matter unless it has any major bearing on what the policy response from central bankers is likely to be. And, I think, the headwinds that the US is facing, they've ramped up quite a lot, in the past few months. We've got, more policy feed through that markets need to kind of digest. There's things like dwindling savings rates, which are keeping things propped up, the student loan repayments. And then also, you've got the concern over what's going on in Washington. Yes, again, it's gridlock. People don't want to keep running these higher deficits. So, there are a lot of headwinds, but, the whole theme throughout 2023 is, not to bet against the US economy. Things haven't really been as bad as people have feared. That's even true here in the UK. It's here in the US. People always want to come out with the worst case scenario. And yes, I think things will slow, but I don't think we're going to see a recession or like a full-blown recession. So I think this is just an inevitable part of the cycle, which we're just kind of playing out through.
Yeah, I think that's a good way to look at it. And as you say, there will always be people trying to, spread doom and gloom and fear and all the rest of it. Go on, Ryan.
Sorry, yeah, just I did get a bit, sorry, just firstly to apologise for moving on to equity. So I actually forgot equities was the next question. But just to follow on from what Adam said, as always, he's always nailing it. I didn't mean it like that. But we've got obviously the possible. I honestly didn't mean it like that. We've got. I'll start again. One sec. So we've got the looming prospect of another government shutdown just around the corner, like 2 weeks' time, and we got very close last time, a few weeks back. It's amazing how quickly 40 days goes, or 44 days, whatever it was. But there's now a really significant chance we're going to have a government shutdown. But what you need to do as a trader or an investor is separate a government shutdown from impact on the economy. Because I'm telling you now, we're going to have so many talking heads saying about it's the end of the US, it's the end of the dollar, so everyone's going to default, all this crap just based on the government shutdown. I truly believe that we probably will have a government shutdown. Why not? We're coming into Christmas, right? Everyone loves a shutdown over Christmas. But when I say this, I don't think for a second it will impact the economy. I don't think it's going to. Sorry, when I say the economy, it's not going to impact stocks and stuff. I know we're going on to stocks anyway, but just to flag for listeners or viewers, government shutdown does not equal the end of the US. It just basically means a pause in administration.
Yeah. No, 100%. Adam, why don't you come back on that, and then we've got to move on.
Sorry, yeah, okay, yeah. I think when I mentioned the fiscal concerns, it's not the US economy is going to slow down from government shutdown. It's more the point of contention is that there's a lot of reluctance to keep running these higher and higher deficits. That's like the bone of contention. So it's kind of how that plays out. So there's even talk of them having a debt commission to kind of oversee this, and then do markets start punishing them for running deficits? That's the angle. If you're going to look at government shutdown, to look at it, not the hit to GDP. If a few people don't sweep the parks for a week or something.
Especially as that will just get thrown back onto GDP as soon as they reopen anyway.
Yeah, exactly.
Right, let's get on to the second half of the show. Right, well, Ryan, you were talking about this anyway, so we may as well kick things off with you here. The S&P 500 having its best week in just under a year last week. We're back above the 50 and the 200-day moving averages now. We're looking to take on 4,400. In fact, the front month future just nudging north of that level by a single point as I speak. You're always bullish on stocks, I know, but do you think the worst is behind the market now? Absolutely.
Next question. No, it's like, seriously, like we said, if as much as people would love to hate on things like the SPX and the US and whatever, and if you're bullish equities in any shape or form, you have to be bullish the S&P. People try and glamorize it and try and dress it up and roll it in glitter and come up with all these other things. But at the end of the day, if there's an appetite for stocks in the world, historically, recent history shows you that appetite will first and foremost be in the S&P. And why not? It's an index. It's an evolving index of the 500 most suited companies pretty much in the world. I know it's US based, but everyone clamours over themselves to be a S&P 500 company. So from that viewpoint, equities, worse is behind us. Now we've got the CTAs and all these are trend following kind of funds and stuff that are coming on board because we're now above the 50 and the 200-day moving average. It's no secret that I absolutely detest 99.9% of technical analysis. But the technical analysis I do appreciate, and that's from my time on various broking desks and whatnot, and this is like institutional broking desks, are simple moving averages. Why? Because people use that's more relevant to your fund desks and whatnot than are we in a bear market or a bull market. The fact is they're just really shit technical definitions. When are we above the 50 moving day average? Are we above the 100-day moving average? Are we above the 200-day moving average? If we are, we're in a bull market as far as anyone with real money is concerned. So for those reasons, I think now, as much as I hate the idea of buying highs in this environment, But gun to my head, I'd be buying the high here. And then, I think you've got every chance, obviously we'll probably get a small pullback or we'll get a pullback, but if you can, then you add to it. And also, don't forget, we always have got that central bank kind of policy response if the shit did hit the fan. There's already so much pressure on them to look to cut, the Fed, or anyone really, that the moment that the shit does start hitting the fan, policy response is going to be tomorrow. I think that the odds are stacked in your favor to be long stocks, more so than normal, or usual, sorry. Again, just it comes down to watching the 10-year yield as well. If you think the 10-year yield is peaked, then double up. Not financial advice.
No, I very much agree with that, and I agree with your point on moving averages as well. Although I'm a little bit perturbed that you don't think there's value in something like Elliott Waves, but maybe.
And Ryan leaves the chat.
Right, Dick, what are your thoughts on the equity market? Because something tells me you're not going to be quite as bullish as myself and Ryan. And something tells me also you've put yourself on mute somehow. What's he up to there?
That's because I thought you were going to ask me about the Elliott Wave, and I didn't think you'd want to hear my response.
Oh, very good.
Good recovery.
Yeah, I do. I will say that I do agree that 50-day, 100-day, and 200-day moving averages are probably the only chart signals that I would watch, and I think institutionally they are still the most important, and logically to me that they work. So I absolutely agree with my little friend Ryan on those. Having said,
concentrated chaos is what I was called today.
You were called what?
You were called what?
Concentrated chaos. I think that was a jab at my small stature.
Yeah, there's another C I've heard you described as.
Back to your email again.
Having said right at the beginning of this that I do actually believe in US exceptionalism, and I still think the US economy is doing so well. How can I not like the S&P? That's the bottom line. That it is the concentration of the world's greatest engine, I guess.
Exactly that.
Fundamentally, I'm not sure I'd come in and buy it here. Certainly not if Ryan's buying. I'm not sure I'd want to join him on buying the top of the market. I think there are some worries, as there always are. I don't agree that the Fed will come in and rescue the stock market. I just think those days have gone. I think there are worries there. I think that the deficit is going to carry on growing. I think they're going to have to start giving out more and more weapons to Ukraine and Israel and wherever, which will make the deficit grow. But it doesn't seem to affect the stock market at all. And it just carries on. I've got very, very little to add. I would favour going to Holland next week that we're going to have a St. Nicholas rally as opposed to a Santa rally, purely because St. Nicholas is the 6th of December, and I think it could be all over and done with very, very quickly. But, I guess I'd be a reluctant long. I'm not sure I'd buy, but I'd be a reluctant long, if that makes sense.
Yeah. No, it makes perfect sense. But, reluctant or not, you're still joining us in that bullish camp. Adam, so we've we've obviously come through earnings season. I think that's pretty much done and dusted now. About 80% of the index have reported. So if you look between now and the end of the year, what should traders really be thinking of as the key kind of risks and catalysts that could make us three either very right or potentially very wrong?
So you're right, earnings season is pretty much done, but it's worth bearing in mind, I think it's Walmart, it might be next week or week after, but you basically have that week where it's basically just like Walmart, Target, all those retailers reports. So do keep that in your mind, because that's obviously from a macro perspective.
Will they be on target with their results?
Oh, behave.
Sorry.
I'm just putting the price of my invoice up.
Wait, you invoice? What?
So, I think the interesting thing that we've seen happen over the past few weeks is that, equities, they're kind of pressured by the pickup that we did see in yields before last week. And that was, some of the earnings were soft, large cap tech earnings, some of those are disappointing, a few other issues. Last week, we kind of saw the reverse of that. Yields pulled back, stocks enjoyed it, happy days. And so we're in this kind of, paradigm at the moment where, in terms of bond prices and stock prices, there's a positive correlation between the two, where, the bad news we've seen is being good news for the equity space. And in the short term, that may have been also exacerbated by short covering or something to that effect. In the short term, that holds true. I think the big concern for the market is how long does that hold true? Because in order for yields to keep going lower, you're probably going to need more soft data. And then, at some point, if the underlying fundamentals of the US are soft, corporate America does need to kind of reckon with that at some point. And I know, so therefore, do we see a flip in that correlation between bonds and stocks? And then does it go negative if, bonds do keep moving higher? Because we have seen, I know there are two bears which people kind of like to disagree with, but, the likes of Kalanovic of JP Morgan, Wilson of Morgan Stanley, they do raise some good points that if this does come to fruition, then EPS revisions will have to come lower at some point. And, at that point, do people question valuations? I think that's the clear risk from a macro perspective. And then also, as we mentioned, do we get a surprise hike by the Fed? I think that's one of the wild cards. If financial conditions do ease, then they need to kind of step in. Do we get an end of year December hike? And does that really kind of sour sentiment as we kind of head towards year end? And then, what are like the ramifications of that? We saw the Fed loan officer survey early in the week. And again, it's this picture of tightening credit standards, lower borrowing, etc., etc. Do we then see a Fed hike? Do we saw more concerns about Fed regional banks that thought all these hikes were over? Is that something, is that kind of a theme that we see at the end of the year? And then we've also got other things, look at the rest of the world. Eurozone isn't doing great. China, yes, the GDP figures were good, but I know, as I'm sure Ryan's waiting to say, you can't trust the data.
Made up.
So, made
up by these figures. You can't put any credence on them whatsoever.
Exactly. And then also, don't forget, there's still conflict in the Middle East, which for now, I think you've seen a geopolitical premium unwind, but ultimately the intensity of the fighting hasn't really kind of slowed down between Israel and Hamas. Then at that point, does this become a proxy war at some point? So I can very much see a potential confluence of factors coming together, which could unnerve the market, but I think it's very finely poised at the moment.
Can I just
very much so.
Can I just quickly add something?
Go on.
Yeah. Isn't it quite a window onto how the markets are performing or markets are trading right now, that we have got war in the Middle East, and that was the first moment in this whole webinar that we've mentioned war in the Middle East.
Yes.
Can I also just mention as well, because we're talking about the S&P 500, really when we're talking about the S&P 500 and the US stock market, we're talking about 7 companies, because they're propelling everything. Year to date, the S&P 500 is at like about 14-15%. The equal weight S&P 500, which I know obviously isn't going to be a preferred instrument for people to trade, is actually down 0.5%. So when we're talking about the stock market, we're talking about 7 companies.
Here's my counterpoint on that. So what? And the reason I say so what is because a company like Amazon are pretty much mainstay of a lot of people's lives. So it's not like the olden days when if it was one computer, say it was Dell or something like that, you say, oh, Dell's a massive part of the S&P 500 and they only do computers. Yeah, that's warranted. But Amazon, they're where I buy my shopping from. They're also who host my website. They're also doing all these other things. So you know what? They're not just one company. I think people have got to get out the mindset of, oh, it's only controlled by 7 companies, whatever. But those 7 companies, Google, for instance, Google are like the internet, and the internet is everything. So I think people do have to realize that these one-name companies actually have a million different facets that reach into everyone's lives. So honestly, I think the whole, it's weighted in just 7 companies kind of thing, I think that's overblown a little bit, because we live in the sort of times where Amazon is integral to a lot of people's lives on many aspects. Same with Google, same with whatever is. I think that it's kind of old money is kind of the ones that are kind of bemoaning it. Anyway, that's my
S&P 5. My point is the S&P 500 isn't the only index in the US. Within the
only one that matters, mate.
And if you're looking at the S&P 500, it's 7 companies which aren't replicated in something like the Dow or the Russell. And if you look at
Dow, no one talks about the Dow.
Well, the old people
dividends, you can piss off.
I'm just making a distinction between the Magnificent Seven and corporate America as a whole.
No, it is a very important distinction to make. I will note that down because we do need to have a proper conversation about that. But sadly, we don't have time now, and we need to get on to the last round. But it is a very important distinction to make, nonetheless. Right, the last round of the show, I want to talk about the Treasury market. Dick, let's get things cracking with you here. I mean, we've seen the 10-year Treasury come back from just north of 5% to 4.5-ish% at the time of recording. I mean, I guess there's two parts to this question. One, what do you think's driven that move? And two, do you think that we've seen the high for this cycle now?
I think there are quite a few reasons for the move. It was probably started off the back of the non-farm payroll numbers being a little bit worse than people expected. Excuse me. But sorry, I'm dying here. I'm dying. It's so hot in this room.
He's just trying to get sympathy for points. Don't fall for it.
We know where this is going.
Sympathy on this show.
We're going to have a government shutdown here. I think the market was exceedingly short, and it got caught short and got squeezed. So I think there's a lot of short covering going on, which exacerbated the move. 4.5% seems to be at the moment the bottom. I think that the supply is still there. There's billions being issued, although I'm reliably informed that $1 billion isn't that big a number. It's only billion seconds is only 31.5 years, I think Ryan pointed out recently to me. So I think that, that to me, the issue is going back to what we were talking about earlier, is the problem that the Fed's got, because actually they'd probably quite like to see yields higher than they are to control the economy. And you've got like this sort of catch-22. As bonds come lower, you're going to have as bond prices, bond yields come lower, you're probably going to have more pressure on the Fed hiking rate. So it's sort of like a catch-22 they've got there. I'm not convinced we've seen the cycle highs. I think core inflation is still humming around about 4%. It's a really, really difficult one to actually say that we've seen the cycle high there. The one thing that, touching on what we were just talking about, the one thing that really does concern me, and it's concerning that we haven't really talked about it, and it's the most dreadful subject, is what's going on in Israel and the Middle East. And I find it very, very hard to believe that we've seen the worst of it. I think it's a month since that dreadful day in Israel. I think it's going to carry on. I think it's going to get worse. I think Iran sooner or later will get sucked into it, which will have inflationary impact. But then what do you see? I suppose you see a flight to safety and people will buy bonds. It's a difficult one. And of course, you've got all sorts of other things going on. I think it's quite interesting when they've been talking about Ukraine hitting nuclear plants in the last couple of days. And they're talking about testing nuclear weapons. So I'm really, really concerned as a human being what's going on out there. But I think that could lead to a flight to safety coming through at some point. And I'm just, to close, I'm going to throw a really, really strange number out that on this basis of flight to safety, traditionally people will buy gold and they'll buy the dollar, which lead into buying bonds. I saw a figure today that 700,000 new Bitcoin addresses have been created in the last week or so. And this is retail buying Bitcoin. Are they buying Bitcoin as a flight to safety as opposed to buying the dollar or buying gold? There's this sort of feeling that there's a lot of uncertainty. So I'm just really, really nervous about the whole situation. Inherently, I think the bond yields go higher, but I think there's an argument that you will see a massive flight to safety because the world is on a precipice, the like of which I've never seen in my lifetime.
Yes, and he's seen a lot.
He has.
I have. I mean, all joking aside, actually, I've seen the Iraq invasion, seen 9/11, all of these things. What goes on now is much, much worse. It makes 9/11, it is tiny in comparison to what happened in Israel. The numbers involved in Israel compared to 9/11 are much, much greater proportionally. And and I'm not going to get political or religious about it. This will not stop. They will go and go and go at each other. They will not stop. And I think it will spread out from the Middle East. And there's certainly actors who want to see this happen. Iran wants to see it happen. Russia does. I think China does. And let alone little Rocket Man, who's very, very quiet at the moment. But I wouldn't bet against him getting involved in. So I think that we are on a, I'm sorry to be doom and gloom, I'm going to end the show on a happy note. I think that we've got a whole plethora of problems facing us.
That's got to be disappointing.
Right, Adam, can you brighten our spirits a little bit after Dick's in the doldrums at all there? What are your thoughts on the Treasury space at the minute, mate?
You kind of frame this in the context of, is this the end of the Treasury bear market? I think, the main characteristics of the Treasury market in the past week, which I wrote down on my notepad time and time again, was the three big things we saw last week: soft data, the refunding announcement, and then a dovishly perceived FOMC. So, in the short term, I don't see much kind of pushing back against that. I think you expect data to remain soft, but as Dickie says, it does appear for the 10-year yield that 4.5% is pretty much kind of the floor that the market's kind of going with for now. I think, in order to kind of push below that, I think you need to kind of see a more dovish, kind of response from the Fed somehow, whether that's, confirmation that they're going to skip December and January as a hike, just fully take that off the table, or a real slowing down of the economy, which, kind of moves the conversation on for the Fed of, could rate cuts come sooner? And as we've mentioned plenty of times, the key theme throughout the market for 2023 is the market has been desperate to be way more dovish than the Fed at every single juncture. So I think, if things do begin to sour, I think the market will easily just jump on that. I don't think, we're necessarily there yet, but that's kind of what I'm looking out for heading into year end, with the caveat of the point, which I've made kind of several times now, is that there's a rate at which the Fed will tolerate financial conditions easing, which, financial conditions aren't this, one individual metric that you can just type into Google and see it pop up. Everyone has their own ways of measuring it. But ultimately, if financial conditions ease too much, then do we get a hawkish Fed? And that's the biggest risk of the call of calling for the end of the Treasury bear market, in my view. So I think, short term, I'd say monetary policy and US data, but medium term, and I think, Dickie's made the point as well, I think it's the fiscal space which is people should be more concerned about. Like I said earlier, how was Washington's approach to constantly running these deficits? We've seen this, of course, this deficit commission to be set up, but at the end of the day, the US, just love issuing debt to fund whatever it is. We've come through COVID, Russia, Ukraine, and now there's Israel as a conflict. There's always something which is going to mean the US is just going to have to keep rolling over its deficit. And, at some point, do the rating agencies punish them for this? And therefore, do we, even if in the short term the bear market might be over, bigger picture, are we potentially, in a bigger part of the bear market for the Treasury space? So short term monetary policy, medium term fiscal.
No, good stuff. And of course, the other thing to remember on the fiscal side of things is we are less than a year out from the presidential election and the Senate and the House and all the rest of it. So, that is, I would expect, going to become a much more significant talking point, certainly in the political realm, as we move through the next 12 months. And of course, you get the GOP and the Democrats trying to draw some dividing lines between each other. I think talk of deficits and borrowing is only going to increase as we move through the next year or so.
There's also have follow through for monetary policy as well, because any rate cuts which take place before an election, you're going to get the other side saying that they're not playing fair. They're playing up to the incumbent. So I think even monetary policy will get political as well as fiscal policy next year.
I agree. Please let Trump be back on Twitter by that point, just purely for the entertainment value, nothing else. Ryan, let's wrap up the show with you, mate. You said rightly earlier on that the 10-year is the most important instrument in the world to be watching. So one question, where's it going next?
Yeah, well, I'm not going to score many points on this round because I haven't got a clue. So as Dickie said, 4.5% is the new 5%. We seem to have found a bit of a level there. I wouldn't be able to call it, mate. I'm not sure why we were up where we were to begin with. So where we've come back is, to me, we're in a bit of no man's land. Everyone that appears to be ball chasing, and rightfully so, to be honest. I can't make head nor tail. Well, I'm not going to sit here and try and predict the move, basically. I'm happy to chase the ball as everyone else seems to be doing. What I am using is where that ball goes to dictate what my attitude is to risk in things like the S&P and stuff like that.
If you'll put your Ichimoku clouds on your chart, Ryan, and that.
Oh yeah, got loads of them. Loads. I've got Ichimochos coming out my arse. But look, the only thing you can kind of look at is, looking at the rates, the rate environment. I think what CME's market, FedWatch, have got cuts now coming in May, was it? May could be the first cut. I think that's a bit too optimistic. So if you imply that and you decide and you kind of say, okay, well, the rates are going to kind of twist that and move that back to, say, June or August, September, whatever the meetings are after that, then we get a bounce in the 10 years. But quite frankly, there's just so many plates. There's so many like spinning plates in the treasury market at the moment. Like as Vicky said about, in terms of how baked in is that trade, and obviously the basis trade, and it's not for me, mate. I'll take the wooden spoon on this round and just go. I'm no idea.
No, good stuff. Go on.
I was going to say, what I think is really, really funny is the Fed now saying that it's data dependent and central banks are now data dependent. Why weren't they data dependent when inflation came in? Why did they ignore that? And why should any of us trust their opinion now because they couldn't read the data as inflation went up? Why can they read it any better now? That's the end of my rant. Great game. Well,
I think that they're now trying to be reactionary, whereas before they've been kind of proactive. I think, and being proactive can, obviously, if you get the data, if you call it wrong, that's when you get done up the ringer. Sorry. I should have just stopped. I should have. Right, I'm done. I'm not talking.
You did so well. You did so well.
Did very well. He did very well. Right, let's get on to the scores. Well, Ryan's done about as well in this show as his horse tip for the Melbourne Cup did earlier in the week, in that they're still running. Sorry, I had to mention it. Adam, well done, mate. You have not surprised anyone with that result, I don't think.
I'd just like to say, I'd like to say thank you, Michael, for my plethora of points that you gave me. Very appreciated.
Is it too late for me to take some off him? Right, that does bring us to the end of the show. Thank you very much to the gents for joining me. Richard Matthews from 1.io, Ryan Paisey from PiQ Suite, and Adam Linton of Newsquawk. Thank you very much for watching as well. If you've enjoyed the show, drop a like on the video, leave a comment as well. Let us know how you're trading the markets, and we'll be back with another show this time next week. Thanks again. Goodbye for now.